Well, good morning, everyone. My name is Mark Lyons. I'm the Director of Sales here at Senior Market Sales, and welcome to the 2025 webinar series. We'll be hosting a webinar about once a month, and this is the first one of the year. For 2025, we have a special guest to start off the year. We have with us Luke Ramsey. He's the president of Evolved Life Settlements, which, by the way, is a Senior Market Sales subsidiary. So welcome, Luke.
Thank you, Mark. Thanks for having me.
Yeah. Luke today is going to share with us all of his knowledge about life settlements. It's really a kind of a confusing area for those of us that don't spend a lot of time, but it's got a lot of great value for producers, for clients, and so why don't we just start it off with giving us a 10,000-foot view of the life settlement market, Luke, and Luke's got a presentation that he's going to share with us. During that presentation, we're going to talk about some success stories, and he's just going to walk us through this process. And I'm sure, after everybody sees this webinar, there'll be a lot of questions. Just reach out to us, your marketers or me, and then we can get you in touch with Luke, and maybe we'll have Luke's contact information here directly in the presentation, but we're really looking forward to the information you have to share with us, Luke.
Great, Mark. Thanks for having me. I'm very appreciative of the opportunity to come speak with you. And this area of the business gets me so excited. I've spent my entire life in a brokerage general agency, and the life settlements market is just exciting to me. And I think you'll find it the same way as we kind of get through this presentation here. Just to get us started here, there's some disclosures that I need to make sure that we're not offering tax advice and it's for professional use only, all of those types of things.
Yes, certainly.
I'd put together my bio, and for whatever that's worth, it's gives a little history on me and kind of my background. The key ingredient is this is the only job I've had since I was 11 years old. And so if you ask me a question outside of life insurance, I'm not very smart. But if we stay in this narrow realm, I can hold my own. So maybe just to kind of talk about life settlements, maybe we can just kind of give a broad overview and start there.
That's fantastic.
Whenever a life settlement, Wikipedia defines as when you liquidate a policy for more than its cash surrender value, but less than its net death benefit. We'll explore that a little bit more, but I think it's a pretty good definition of what a life settlement is. And the distribution. So everyone on this call is probably comfortable with how typical insurance distribution happens with carriers. Within the life settlement market, when we talk about the primary market, that is when consumers are purchasing life insurance through an advisor, through their agent, and putting policies in place to protect their family, their business, their trust, their estate, whatever it might be.
And that's what we do every day, all day, right?
Yes, sir.
Yes, okay.
And then we move on to a second piece of the life insurance distribution called the secondary market, and that's when a policy owner is done with their policy. They no longer they sell their business. They no longer have a business, and they still own policies for buy-sell purposes, or they bought policies for an estate tax need, and that estate tax need is no longer there. Maybe they bought a life insurance policy for income protection for their family, and now they've gotten to retirement age, and their nest egg is there. They've hit their number for retirement, and so they no longer. So when they take those policies and we sell them, that is called the secondary market. And then there's actually a third market, which is where the buyers of those policies trade amongst each other, called the tertiary market. And a really interesting space, but we will primarily focus on the secondary market in this presentation today.
And so That is all real interesting. And I think you're probably going to share with us, who all the players are, like what a buyer and a broker and what all those people do, right?
Yes, sir. Yes, sir.
All
So,
right.
as we kind of get into it, at the in the top left-hand corner, you'll see the policy owner. That's the person that originally bought it bought the policy in the primary market. Whether or not it's a trust, an individual, or a corporation for those situations that we talked about, and they usually went through a retail broker. Well, that a retail broker can also participate in the life settlement space. And normally what happens is that retail broker partners with a primary broker, which is the position that we fall into. Evolved is a primary broker, and we partner with retail brokers to help their clients. We've got relationships, and we do all the form filings and the compliance issues in order to be able to work with the providers. And you can see how I've put in quotations, the buyers of the policy is the provider. And then behind the providers, the hedge funds and the large family foundations that fund and buy the policies, ultimately, they go through a provider to get to us in order to have all the compliance issues tackled. So that kind of lays out all of the different people involved in the process.
All right. Well, that's great. Okay. All
Maybe
right.
maybe I could just take 1 second and kind of focus in on that primary broker role for the
Right.
provider role for a second. Um, to become a provider that's a buyer of these policies in the secondary market, you have to go through, get authorized by the state. You have to do a bunch of filings, pay fees, keep a bunch of stuff up to date. But within that realm of being a licensed provider, there are two types of providers. And these are a really critical difference, in my opinion, as you approach this space. One is the direct buyer. A direct buyer is someone who goes directly to the consumer. They purchase the policy directly from the consumer with no commissions involved. And what they do is they already know what the policy is worth on the tertiary market. So when they buy it, they want to buy low and they want to sell high, and they get to keep the spread in between those two numbers. That's their profit. So their goal is to be able to buy the policy as cheap as they can, but still buy it. And they already know what it is worth on the tertiary market. So when they buy it, some people hold them. Some people immediately flip them on the tertiary market and take their profits. That distribution is a lot different than the brokerage life settlement space, which is what we're in. And that's where we serve as a legal fiduciary for the policy owner throughout that process. And we don't just go to one buyer, but we create that auction environment. And we hopefully know what it is worth on the tertiary market. And we are trying to push the buyers, the providers, to purchase as close to what the real value of that policy is on the tertiary market. So we squeeze their margin down to the smallest amount possible, and that provides the most for the consumer. And so us serving as that fiduciary hopefully brings a lot more value to the consumer, along with a commission that's paid to the primary broker and to the retail broker.
So a consumer that has a policy that, they don't need anymore has one of two directions they can go. They can call the number on the TV ad that they see, and that's the direct buyer, and they're probably not going to get the best value for the sale of that policy, or they can use someone like Evolve Life Settlements to help get the best price for that policy. Is that
Yes,
right?
sir. That,
Okay.
that is correct. You got it.
All right. All right. Well, go ahead and let's keep rolling.
Okay. When we get into this space, there is a little bit of licensing compliance. I'm not going to bore you with it, but I do want everyone to know that we are really compliant, and we are focused on what the regulators are looking for, making sure that we keep you in the know. So it's not a problem until it's a problem, is the saying. But we always ask these questions as we get involved with a retail advisor that possibly has a case. Do they want to receive commissions? Some of them can't receive commissions. Is there a broker dealer involved? Is the advisor structured under an agency for liability purposes? Are they as an individual? Does their E&O allow it? So these are the four questions that we really start out with. The making sure that we set you up and that we develop the items that are important for you to stay in compliance is a big focus for us. So I won't bore you too much with licensing and compliance, but I do want you to know that it's important to us.
Well, being compliant is very important to the company. So we're glad it's important to you too. So how do you identify advisors that should make this part of their practice?
Okay, great. Well, I know that SMS has a wide variety of producers that they deal with and advisors they deal with on a regular basis. And so when we talk about what is the right fit, high net worth clients are the right fit. Policies that are face amounts of 250,000 and higher. 250,000 is kind of the entry level for a life settlement. We're going all the way up to 5, 10, 15, $20 million face amounts is the space. We work with clients that are typically over age 70. If clients have major health problems, sometimes we can work all the way down to age 60. But the hedge funds that are ultimately become the owners of these policies or the funders, they are not looking for a 50, 60, 70-year time horizon. They like to see 15, 20 years and young and shorter for their return. So that kind of might set a little bit of a guardrails around clients that might be of interest to this space. Practice on protection policies. So if a advisor is in the accumulation life insurance space, they're still an IUL that's max funded. IUL that's max funded, whole life insurance. There are occasions where those are fits for the life settlement space, but it's typically the minimum funded to take a death benefit out to age 100 is what the life settlement space is looking for to buy. Term policies, I love talking about this because this is just a home run, which are term policies that they don't want anymore. Good company, good conversion products, your North Americans, your United of Omahas. There's so many good companies out there that have great conversion products and allow those conversion products all the way out to age 70, 75. And those make great candidates for life settlements. There's also a really big segment of guaranteed universal life policy was issued between 2001 and 2012. And even without a change in health, these policies have value in the settlement space. So whether or not it's UL or term, we can walk through the process. We've got a pretty quick vetting process for each case, so you'll know if it's a fit or not pretty quick. I think one of the things that we find are successful in this space are when advisors have review programs with their customers and they're watching the performance of the policy and the clients are informed. In those situations, that's where we see people go, we don't need this policy anymore. It's underperforming, whatever it might be. We're monitoring changes in their goals. We're watching for COIs. We're looking for carriers that have buyback programs. This is kind of new to the market in the last 6 or 7 years, where carriers that sold those GUL policies between 2001 and 2012, they don't want them on the books anymore. And so they're going to the clients, they're trying to buy them back. We want to create competition for those carriers that are trying to buy them back and see if we can't get you, more than or 2 or 3 or 4 times as much as what they're offering in a buyback program. Older age, they're selling their business. They don't need their policy. It's underperforming. Advisors that are really trying to stay with their clients and advise them through the entire service cycle of the sales process. That's where we find success.
All right. Well, that's great. So how do we identify them then?
I think jumping into the the older age folks, the underperforming policies, there is kind of we put together carriers that have done COI increases, a list of them. We've got a whole book that puts together all the carriers and what their rate hikes have been through the years. And I think a lot of those are opportunities to go meet with your client and find ideal customers, whether or not their goals have changed or not. The COI hikes have a major impact on the performance of those policies.
Oh, absolutely, absolutely. Okay, so these are all available to the agents and the
Yeah, so
producers
we
and the
we have
advisors.
we keep a stack of them in our in a kit that we have available so that we can go back and reference the changes. But yes, if there's a policy that we want to bounce against that database, let us know.
Okay, all right, all right. That sounds great. All right. Well, please continue.
Okay. Well, maybe just to tell you a little bit about the settlement process and what happens as we go through the settlement process. Typically the first thing we want to do is we want to give the clients a ballpark value of what the policy might be worth on the open market. And so we kind of get an initial buy-in to determine whether or not it's a right fit for the client's situation and vet any questions that they might have. Once we find out that they do want to proceed, that's typically where we're getting paperwork done, we're getting medical records, and going through the medical file build process. Once we get there, we're going through the underwriting process behind the scenes, and once that's completed, we submit the case out for auction. So we have all of the licensed providers that are in a certain state, since it's state regulated. We go to those providers, we put the details out for auction, and then what we're doing is we're constantly reviewing the bids. And when someone stops bidding, we remove them from the auction and we keep the bidders that are still going and still see value. And we try to drive the price up until we get down to the last two or three. And that's where we typically go for a best and final style auction to end it and find out who. Then we report those back to the consumer and to the advisor to see, is this acceptable? Did we meet the goals and the expectations that we had set up front in the policy valuation process? Then we get down to the last two, which are, the closing package. It's a thick piece of paper. I don't want to make it sound like it's an easy process, but it's filling out. It's like buying or selling a house. It's a paperwork, but we're really really good at making it easy. And then once the paperwork is completed, it goes through a review process. And then the ownership and beneficiary change forms are submitted to the carrier. And as soon as those are processed, the escrow agent at that point gets notice and they release the funds to the client. So that kind of gives you a good outline of the process that we go through on a settlement.
And ELS, Evolve Life Settlements, is walking through that process with the advisor and the client every step of the way.
That's right. That's right.
Okay.
There are so many details along the way that we are heavily involved at every step as we go through this process. And hopefully we're bringing a lot of things to the table. Maybe I can start with just one of those, which would be like our life settlement valuation tool. And this is where we, can show a client based upon, what they think their health is and what they think their life expectancy is, what the policy might be worth. And so this tool helps us really gauge the customer's situation and whether or not it's a good fit for their scenario, because we don't want to go through and just a 60-day process to find out that it wasn't a fit. So we try to vet the really hard questions up front so we're not wasting the advisor's time, not wasting the client's time. Are values in line with what their expectation are? Have they already looked at alternatives if to the life settlement space? Have they already vetted family members that might want to take over those policies? We ask all these questions so that we're not wasting everyone's time and energy just to go out and shop the file to see what it's worth. Yes, sir.
And so
Go ahead.
and so when you're running this calculation tool, does it spit out something that the agent is able to, or the advisor is able to take to the consumer, or Are you involved in that conversation?
We're usually involved in that conversation to touch on all the details. This is the presentation. And so we'll typically send this back over, and then we'll review it with the advisor and the consumer together, either on a Zoom call or in person, whichever is more suitable for the situation.
Okay.
One of the key ingredients, I think, Mark, to going through our process is a little unique in that, we're very open about one thing that's really important, which is a policy that can be sold on the life settlement market. It's better for the family to keep it. It's better for that person to keep that policy. If I can sell it, the first thing we do is we encourage them to keep it. It's counterintuitive to the sales process, but what it does is it really gets them thinking about the alternatives to selling a policy, because it all too often, if you don't vet this up front, you'll get to the end of the process, all the work is done, and that's when the clients start to think about other things that they could have done, and you don't want to go through all that work to find out on the back end that they actually want to pivot and go another direction. So we're really good at vetting all of those and jumping all the hurdles up front.
Okay, that's great. Okay, so then what do we do with the proceeds?
There's a ton you can do with it. It's cash, and so vacations are the thing that we hear the most. But treatments for health problems, retirement, income streams, taking care of taking care of long-term care concerns where maybe they didn't do the proper plan, they didn't buy a long-term care policy, whatever it might be. So these when the settlement proceeds come out, they typically come out in a lump sum. Sometimes we do what's called a split option, which is they just retain a piece of the death benefit, but they don't have premium requirements going forward. Kind of an interesting play. Not a lot of life settlement brokers will participate in that space, but what we found great success there. And then maybe to create a stream of payment to fund a long-term care expense. There is some bills in Congress that have been presented. We haven't gotten it to a vote to try to protect it from taxation. So proceeds maybe wouldn't be taxed. Hasn't gone as far as we had hoped, but it has been talked about and is out there. That might be a great segment into, because the question always comes up: what happens to the taxes when we're done, right? I put this together, and that is this is the Tax Cut and Jobs Act, the TCJA, and when Trump was elected, this piece of regulation really changed everything about how we're taxed on these policies. So when you surrender a policy, you pay income tax on your gains. We're not going to be able to get rid of that. That stays the same. So if we settle a policy and it has gains, you are either going to pay long-term capital gains or you're going to pay income taxes, and that's kind of the difference. I think that if I can, I'm going to move to the next slide, which shows a graph that might be a little bit more, make it a little easier to explain. But you can see the light blue at the bottom is the premiums they put into the contract. The yellow being the surrender value. It looks like it's $200,000 in this example. And then we have a sales price of $500,000 and a total death benefit of $1 million. So this is kind of a standard policy that comes through the door. And in this situation, because your net cash surrender value is at $200,000, you're going to pay income taxes between the cost basis, that's the light blue line, and the cash surrender value. So in this scenario, you'd have $100,000 that would be reported as income taxes, and then the additional the additional $300,000 of proceeds from the sale would be taxed at long-term capital gains rates, as long as they've owned the policy for 24 months or longer, which qualifies them for long-term capital gains. So sometimes on a zero cash value policy, you're just paying capital gains on everything. But when you have cash value in there, they're going to put income tax rates on the amount up to the surrender value. And anything you get above that in a settlement is at capital gains rates.
And that goes into part of the analysis when you're advising the advisor and the consumer whether it's brought up as a topic.
It's a big part. We stay very close to the statement that we can't offer tax advice, but what we do is we help them and we provide the data for their tax advisor to give them the best advice. And we've been through it so many times. We typically can give them a really good a path to go down to evaluate what their tax consequences will be.
Yeah, and you made a mention of having done this more than once in your comment that you just made. How long you been doing this?
Well, my father was doing it well before I was. The firm got started up in 2011. In the years prior to that, my father was doing it. So it's been a part of our practice for quite some time. But we formalized it and really segmented it off from our life insurance business back in 2011. And it's exciting, Mark. It's an exciting space.
So you've had a lot of cases come through the door.
Oh yes, sir. We look at a lot, and a lot of times we look at a case and it's just not a fit for the space. So vetting all of them and not letting something go by without getting an evaluation done. That's kind of the catch that we want to leave people with. It's easy for us to put it together and let you know if it's got value or if it doesn't.
Right. Okay. And I think you're going to go through some carrier concerns now.
Well, I was just going to say when it comes to pricing, insurance carriers, they price in lapse ratios, they price in persistency, policies. When we go to the settlement space, policies don't lapse. The funders who ultimately own the contracts, right. They have deep pockets. And they're not gonna run up light on a premium payment when it's needed. They're gonna pay them until the time comes. And so, for whatever that's worth, they actually sometimes will even use an annuity to offset any ongoing. So they might fund an annuity to make the premium payments. So kind of an interesting concept there. We talked about the carrier buyback programs already, but it's a space where we get a lot of people shopping against that. And there's also the slowing down of a transaction that sometimes we need to give the consumer more time to think through, to do their due diligence. We might find out with 5 or 10 days left before a policy is set to lapse or a conversion period is done. And we have techniques and strategies on how to buy time with the carrier, how to minimum fund another month, buy 30 more days so that the clients have the right amount of time to make a decision that's a good fit for them. So kind of some of the maybe just experience has taught us those things through the years.
Right. So do you have any examples of success stories that you've had over the years that, when it worked really well, either for the consumer and, certainly for advisors too,
Well, we'll say that the advisors, they are always amazed at the revenue that are created from these cases. So we'll leave it at that. But I think that anyone that has a substantial case that comes through, they are usually shocked at what the commissions are on those for the advisor. And that's kind of a big piece of that is the time, energy, the skill set, the 20 to 30 years of work you put into getting to the point of doing a life settlement, selling the original policy, having the knowledge base, all of those types of things. And that's what justifies the commissions. And not all of them work. All right. So you take 10 of them, we evaluate. We might only take 5 to market, and we might get competitive offers on 3. And so because of those ratios, the commissions have to be big for the market space to work. So from the advisor standpoint, that's a key ingredient. When it comes to the thing that's so cool about this business is, sometimes you'll have an insured who owns a policy on themselves, and their total net worth might be 100,000 or 150,000, and they're moving into their retirement years, and all of a sudden you're able to take a 500,000 or a 250 policy and give them a check for 50 or 100,000 or 150,000, and tears come up. Mark, it's we've had that on many occasions. Um, uh, Another example that you might find interesting is when partners have buy-sell agreements, and they go and they sell. The gray wave is selling their businesses left and right in today's marketplace with the mergers and acquisitions. And those buy-sell policies that are sitting out there, they create great opportunities for life settlements to tack on to the sale of those businesses. And we've had seven digit checks that we've handed out to consumers on policies where they were sending in a lapse notice. And fortunately, the right advisor saw what they were doing, said, "Hey, maybe we ought to explore this," and it turned into $1 million or $2 million of more proceeds than just selling their business and letting those policies lapse. So
So
really
so the
interesting.
the the best advice for advisors is to tell a consumer never let the policy lapse without at least trying to figure out if it has any value.
Couldn't have said any better
If they're just
myself.
gonna let it lapse and not pay the premiums or whatever, it's always probably worth something to them.
That's right. That's right. Well, we just evaluate each one as they come, and when they're over age 65, that's where we like to start looking at it, and we just look at each one, and if it's worth pursuing, then the client and the advisor make that decision, and then we hold hands as we go through the process.
So, for all the advisors out there, do you have any best practice, suggested language on how the topic gets broached with the consumer or their
Uh,
clients?
yeah, I think that whenever you're sitting with a consumer and they talk about lapsing policies, I think that is the trigger that starts the wheels turning, and should, for an advisor that knows that this tool is out there. And then the conversation is just as simple as, we can return the policy to the carrier, and because of a health decline, because of a really competitive policy, whatever it is, that intrinsic value that is there, you give it back to the insurance company, or you give it back to the consumer that bought the policy. And so I think that philosophy really resonates with clients on whether or not they're trying to enrich their own retirement or their own life versus trying to help the insurance company buy another building, another jet, another whatever it is that where they're making all the money. So helping to build their retirement for the consumer is what resonates typically.
Yeah, I don't think most consumers in this country are as much as all the carriers are our friends in our industry. I think most consumers would say, I'm not going to help them out just to help them out.
Yes, yes.
All right. Well, it's been fantastic, Luke. We really appreciate it. I imagine that after advisors watch this webinar, there's going to be a lot more questions, and so if you're watching this and you do have questions, you do have interest in the process, you can reach out to your team at Senior Market Sales. You can reach out to me, M Lyons, Lyons at seniormarketsales.com. Or you can really reach out to Luke directly. He's part of our business. So we encourage everyone that really wants to work with Luke on this to feel free to reach out to him directly too. And Luke, I don't know if you want to share your contact information here.
Yeah, it's Luke at evolvesettlements.com, Luke at evolvedsettlements.com. And our phone number is 501 404 0000. 501 404 0000. Look forward to talking with you.
And if that's too much for you to take down, you just call your life marketer and we'll get you in touch with Luke. Okay. Well, I want to say thank you to Luke. It was a great first webinar of 2025, and I hope it gets all of the advisors out there thinking about doing reviews of their clients' policies. That's where you kind of start this process, and so we're all here to help. Whatever we need to do to reposition those policies. Maybe life settlements the correct move. Maybe it's repurposing those dollars. There's always a solution to make it probably better than it's being used for right now. So, thank you,
Mark,
Luke.
thanks for having us.
Oh, absolutely, absolutely. We'll talk to you soon, and thank you everyone for joining the webinar.